Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, January 4th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to do about them in your portfolio, you need to be a client of 42 Macro. So starting with number one, the latest batch of key economic data increases the probability of a soft landing in the U.S. and global economies. Number two, the December ISM manufacturing report specifically showcased 3-month highs in the headline and employment PMIs. Moreover, the prices PMI declined to a 3-month low at the slowest month-over-month pace since May of this year. Bears are touting the decline in the number of industries reporting overall growth to just one, which is the lowest level since March 2009, as evidence of a hard landing. We have the opposite view. Specifically, cycle lows in this indicator have historically presaged very positive market conditions, with the S&P 500 posting a median one-year forward return of plus 28%, with a percent positive ratio of 80% in a five cycle sample. And lastly, number three, the November JOLTS reports, December composite PMIs, December auto sales, December ADP employment report, and jobless claims each supported the soft landing consensus embedded in market pricing. Transitioning to my 42 macro dashboard here. So we got a bevy of oversold and overbought signals here from our friends over at Longbow. So we'll start with gold here, getting towards the lower end of its trading range there. In terms of the we got the S&P 500 is actually oversold in the context of its trading range as well. And we got a oversold condition in the NASDAQ 100 index as well. Got a deeply oversold condition on the Russell 2000 index as well. So some signals. We got an overbought condition here on the Shanghai Composite. And then I think that was that was it for the base metals here getting oversold there. So we had a lot of action here in the markets here. We'll kind of leave it at that and transition to our 42 macro aware community. And so we're getting a question from a couple subscribers. The first one reads, "Can you please give us a crash course in how the bank term funding program is affecting market liquidity and the risk to positive liquidity trends if this program winds down in March of 2024?" And so and then the second question is the subscriber would like to learn a little bit more about how private equity affects global liquidity, as mentioned in the Around the Horn, which is our weekly webcast. So I'll address the bank term funding program one first. So it's pretty simple. Obviously, what the bank term funding program is allowing those banks, those stressed regional banks to do is pledge fixed income securities with the Fed to get cash in exchange for those securities, obviously providing them liquidity to meet customer outflows on the deposit front. And so what this does is it artificially lowers treasury bond yields or artificially increases treasury bond supply relative to what those prices would be if those banks had to just sell those securities in the secondary market to meet those liquidity demands by their customers. Specifically with respect to private equity, so we've talked about this ad nauseum in our macro scouting reports, and occasionally I'll reference it on podcasts and whatnot. But a lot of the work that's done on liquidity that I see out there, not in our community but externally, is really hyper focused on central banks. The folks who do that better are hyper focused on the broader government in terms of fiscal policy dynamics and issuance dynamics as well. But that still, to me, is only half the battle. You need to understand what the private sector is doing on the liquidity front to get a holistic picture of liquidity, which is what we capture and report in our global liquidity proxy on a daily basis here at 42 Macro vis-a-vis the weather model. And so specifically in terms of how private equity creates liquidity, so obviously private equity issues debt to capitalize businesses. Those businesses, when they're capitalized, they're not, that investment does not always get invested into new people, new capital equipment all at once. And so that creates cash on corporate balance sheets for those portfolio companies that ultimately finds its way into money markets and or broader asset markets from an asset liability matching standpoint. The number two way private equity creates liquidity is vis-a-vis the profits and cash flows generated by their portfolio companies, which then go back to their LPs in the form of liquidity, which those LPs can then use to invest in other assets. And so it's this reflexive process. And it's not just private equity, obviously, venture capital, or less so in venture capital, but private equity, you have insurance funds who are doing similar things in the corporate credit market as well, pension funds, et cetera. So we have to understand that, both banks, commercial banks and non-bank financial market participants are involved in the liquidity creation and liquidity distribution process in asset markets. And so you have to just keep a holistic view on that. And I think we do a great job of that. Not only keeping a holistic view on that, but also being Bayesian about updating these trends in liquidity and how they ultimately impact asset markets on a daily basis, 6 days a week here at 42 Macro. So we'll wrap it up there. Darius Dale presenting our Macro Minute for Thursday, January 4th, 2024. Everyone have a wonderful day out there. Best of luck out there. We'll catch you here tomorrow. And tomorrow afternoon, we have our January 2024 Macro Scouting Report out to exclusively to 42 Macro subscribers. So if you want to be in the know on all these important macroeconomic dynamics that are causing a lot of people to significantly underperform the markets, we highly recommend you check that out. The price is entirely too low for you to be ignoring that. So we'll wrap it up there. Everyone have a great day. Cheers.